Hello and welcome back. I'm Robert and this is Everything Automatic Algorithmic Trading. I've talked about negative risk to reward quite a few times. In fact, that is how I make most of my profits. What that really means is that I am willing to risk more to get less of a reward. That seems backwards until you understand statistics. Let's put this in a simple way of looking at the market. You are on a straight line, standing at a certain point with a marker on it. If you take 20 steps forward, you will make a profit. If you take 10 steps backwards, you will make a loss. In market terms, your reward to risk is positive, and it's a 2-to-1 ratio. You will make twice the profit for every loss. But in statistics, it's kind of strange, because in order to get 2 times the reward, you're going to take twice as many losses. It's actually easier to take 10 steps backwards than it is to take 20 steps forwards. From the standpoint of the market, price isn't moved just by you alone. It's moved by all of the participants. So if you want to succeed in the market, you need to have a statistical advantage that puts you in a way of getting your profitability more frequently. A 1-to-1 reward to risk is break even, which makes sense until you realize it's actually a loss because you still pay fees in the cryptocurrency market. So even if you break even, you still lose money because of the fees you pay to trade. So that's where a lot of this thinking comes from, that you need a positive risk to reward or positive reward to risk. But really, your trading dynamics statistically will always favor negative reward to risk. Now the chart we are looking at, the spreadsheet, I've done testing with several different strategies, and I'm going to go through and discuss those as we discuss the variances between reward and risk. If you're a Patreon or a subscriber within my Discord server, all of the code here is available. The main framework is open source. So if you're not a subscriber or a patron, there's a lot of information that you're missing out on. Be sure to visit the links in the description if you want to learn more. So we have several different strategies that I've tested. And the very first one is the stop loss the take profit is higher than a stop loss. So that is a positive reward to risk. And we can see it made the worst trades. Now buy sell is just an always in strategy. It's no brains, just a strategy I use to test as a neutral standpoint. It's not really a trading strategy, but rather just a baseline to go by, which is very interesting, as we'll see later, because the baseline actually has some very unique qualities to it. So in this case, I buy, I wait 0.5% to take my profit, or if the market goes downward, at 0.2%, I take a stop loss. So it's a very simple process all the way around, and we have the relationship. But as you can see by looking at the chart, buy and sell did a lot of losses. We have 1-to-1, we have 4-to-1, so forth. But then we get into Bollinger Band's parabolic SAR, and it also has a lot of losses. And we even have a few cases where the sells are zero. Or see, the wins are zero. So what we have is a second point of reference here. If your stop loss is too close, that is, if you don't have any breathing room, and you see this kind of result, then you know it's too close to your purchasing price. So this chart actually helps in a lot of ways. You know you don't give enough breathing room. You know what strategies just don't work well as a general rule of thumb. And you see exactly where and how to optimize your trading, which is what I've done for this particular market, which is ADA. Now, in order to be sure I could get a good reference point, I downloaded the entire market data. So I have roughly 3 or 4 years of ADA on my disk that I use to build this type of strategy. So again, we see anytime the reward is above the risk, we have a high probability of a loss. That is, it's easier for the market to take a loss at 10 steps than it is for the market to make a profit at 20 steps. Even a 1-to-1 is likely going to be a loss. So let's continue through the various stages, and we can see buy and sell is just bad all the way around. Now, potato harvester is usually a very profitable strategy. It's a very unique strategy, and it is, of course, available to subscribers, but it just does horribly on this particular asset. So we can clearly see that for ADA, the potato harvester is not a good fit. Support and resistance with ATR levels. This one didn't do well at all. But again, reward is above risk. More potato harvester failures, more support and resistance ATR. So we can clearly see that some strategies just don't do well. And this really brings me to a point that I want to talk about, as a lot of people have their favorite combination and they apply it across the board. That's not always going to work, as this data demonstrates. Sometimes you can't use the same strategy on every asset. Some assets have a market structure that will just inherently cause losses for a given strategy no matter what. It's important that you take the time to run the tests and analyze. Make sure your strategy at least presents itself in a rational way. Bollinger Band's parabolic SAR. This is an interesting strategy in that we have a negative reward to risk, and yet here is something really fascinating. Only 376 losses and 5,921 wins, but it still did poorly. That's an important consideration. Again, that's why you need to really run these kind of tests. Bollinger Band's RSI. Now, because this is the entire market, you get a pretty good example of a wide range of fluctuations. While not perfect or suggestive of what the future is going to be, it is certainly reasonable enough to carry into paper trading or mimic testing. Support and resistance pullback, 3 candle support and resistance ATR. The 3 candle is either a peak or a valley on the chart. That is, your closing chart will be below the candle previous, and that candle will be above the candle previous, creating an inverted V for a peak. That would be a selling point. It sounds complicated, but it's really not. And once these tests are done, I will have a lot of charts. But we can see we're getting closer to zero. Parabolic SAR Rule 37. Rule 37 is my own special combination indicator that I found over the years. It is an interesting way of looking at momentum and market direction. But you can see by the number of cells that it's also very restrictive in some markets, something to be aware of when working with it. Finally, we make it into the positives. Now, the point of ADA is 1 unit for this analysis. So if you want to figure out what a Kraken position size would be, just multiply the P&L by 10, or move the decimal place 1 place to the right. So right now it's still 0. But we can see that in every case, your reward is less than your risk. These are all negative reward to risk ratios, and they're all above 0. Now the converse is not true, as I just demonstrated, but still, we have a clear sign of pattern, a clear sign of intent once we have the right strategy. Not all strategies are equal. We're looking into the $1 range now for profits. This is a fascinating one. This would be an $8 profit. This would be a $20 profit with a negative reward to risk ratio of 10 to 1. That is, we will take 10 times the loss for every 1 profit. And yet, using a Kraken position size of $10, it would yield a P&L history of $20. Literally double our actual investment. But the strange part, here we have a 2% stop loss, but right under it we have a 1.5% stop loss, and it makes a better profit. This is interesting because this tells you that the market has an exhaustion stage. If you set your stop loss too high, you'll actually lose money. So you need to actually try to figure out where your stop loss should be. You just can't put an outrageous stop loss and just magically win every trade. You have to run these kind of deep analysis. So here, it only took 561 losses versus 566. But the losses it took were deeper than the 566. So even though you take more losses, they were deep, they were less as extreme. And that actually made the difference in the profit from roughly $20 to $30 with a $10 position size. And you're actually going to see that repeated quite often, which is a unique perspective. Here you see, for example, a 0.7 stop loss and a 0.3. The drastics between the losses, and yet the P&L is not that different. That's something to think about also. On a Kraken position size of $10, this would be an $81 profit versus an $89 profit. Not bad. So you can see the dynamic fluctuations that these have. They're not always intuitive between different strategies or even between variances within the same strategy. Okay, again we see the combinations 1.0 to 0.5. This pretty much yields almost identical results. But the big winner and the big surprise, a 2% stop loss versus a 1.5 stop loss. The 1.5 stop loss almost doubled the profit. For the Bollinger Band's parabolic SAR, a 0.2% take profit versus a 1.5 stop loss produced a $220 profit at a $10 position size. That is quite significant. Now, of course, you need to be able to make sure your exchange can reasonably trade these percentages. But the point is, once you see a chart like this, you get a reasonable level of exactly what to test, how to test it, and what to look for. So this stage, with this information, I would take the Bollinger Bands parabolic star module, set it up with a Mimic account, and actually paper trade it and see how well it did with a 0.2% take profit and a 1.5% stop loss. Given the fact that it had so many wins versus losses, it shouldn't take that long to get a reasonable variance to see how well this strategy does in a paper trading or Mimic account style system. But that's really all we have today. Look at the technical analysis library, download all of the information, run your own tests. That's the important part. Test this for yourself, because you might be surprised at what this information reveals about the asset you trade commonly. As I said earlier, all of my biggest profits have been with a negative reward to risk ratio. Very few times have I actually been lucky enough to get a profit variance off of a positive reward to risk ratio. Statistics is a strange game, but once you understand it, it makes trading much easier. Let me know what you think, though. What is your favorite style of trading? And what is your favorite style of indicator combinations? Share your thoughts. Leave a comment below, and be sure to visit the links in the description. Thank you for watching.